All right. Good afternoon to everybody here in Eastern Canada, and good morning to those joining us from the prairies and the West Coast. It's my pleasure to welcome you to the webinar today, where we're talking about Canada's small business economy and specifically covering trends, impacts, and the response to the COVID-19 pandemic over the past 12 months. My name is Jeff Brown, and I'm Head of Small Business Innovation and Strategy here at Equifax. And I'm joined today by a good friend of mine, Jean Gauthier, President of the Food Industry Credit Bureau, also referred to as Profile Credit. If you've never heard of Profile Credit, that's completely okay. However, what you'll learn today is how critical this organization has been during the pandemic in helping guide food credit decisions when raw ingredient providers, food manufacturers, food distributors, and transportation companies needed it the most. You'll hear from Jean in detail midway through the webinar as we dive into the inner details of the food service industry. But before we get to the content, I'd like to pass it over to my colleague, Sandra Shep, who will be covering a few housekeeping items on the logistics of the webinar, just so that we ensure you have a smooth experience here today. So Sandra, over to you.
Thanks, Jeff, and good afternoon, everyone. You'll see our presenters today are on camera in the media player that's on the left side of your screen. Underneath that, you'll see a Q&A widget. Feel free to enter any question you might have, and we'll address them throughout our session today. In the event there are too many questions to get through, we'll generate an FAQ document which we'll send out to you in the coming weeks. Today's presentation is also available in the resource widget for downloading on the left side of your screen, as well as some other documents you might find pertinent. Our slide presentation will show in the middle of your screen, and as well, our session is being recorded today, and you'll receive an on-demand link via email tomorrow. We'd ask that you complete a short survey for us at the end of our session. It will automatically pop up, and if you'd prefer to answer it at a different time, you can access it by clicking on the survey icon at the bottom of your screen. To the right of that survey icon is a Contact Us button. Feel free to send us a note if you'd like further information. Now let's get started. Jeff, back to you.
All right. Thanks so much, Sandra. So with that, let's go ahead and jump into the material, because we have a lot to cover, and well, I'm kind of excited to share it with the hundreds of you online here today. So this year's been a bit crazy, hasn't it? You know, we've all scrambled to find toilet paper, stocked our shelves full of canned goods that we'll never eat. Yeah, I mean, I'm guilty of it as well. I have probably 10 extra cans of chickpeas buried away somewhere in the pantry. And we've all, become accustomed to wearing masks. Even though we didn't enjoy any of this, we did all because, we essentially had to. We were keeping each other safe and digging into the core instincts of pure survival. So on that note, if you happen to hear some birds in the background of the presentation today, it's because I've gone a bit full pandemic, and I'm actually the proud owners of 8 chickens here on my homestead, and maybe a puppy too. But enough about me. Let's get into it and start talking about some small businesses. So really, here's what's at stake here over the past 12 months, essentially the core fabric of our economy. More than half of the businesses here in Canada have less than 5 employees, while 30% of those employed in the private sector are in organizations with less than 50 employees. So just as we as individuals had to learn to live in a new normal, business owners and their employees had to adopt into their everyday work as well. There wasn't a playbook, a list of instructions, a YouTube video that you could watch to learn it. You literally had to work through it, creating plastic barriers, sanitization stations, finding ways to attract their clientele, and live through multiple lockdowns. To say the least, it's really been hell for a lot of small businesses across the country. So let's face it, we all know horror stories of businesses that won't make it, owners who have lost their retirement savings, and folks, we're still living through this. Jean and I will try our best to pave an optimistic picture, but there's an active triage that is happening right now across our country. Our goal of this webinar today is to arm you with enough insights that you can create your own emergency response program to help your own business out, as well as the businesses of your current and prospective clientele. So as these charts show, those very small businesses that are critical employers prior to the pandemic also represented a big part of our job growth before the pandemic took place. If we collectively are going to kickstart our economy, small businesses are going to have to be the place to do it, and not just a handful, it's going to have to be the majority. The argument could be made that e-commerce has gone through a 3 to 5 year acceleration due to the pandemic, and maybe the adoption of it has. However, for many businesses, it's been a necessary pivot as they wait for that face-to-face brick-and-mortar approach to come back in a post-pandemic, vaccine-rich world. E-commerce has helped businesses sustain and provide a select few with an entirely new and successful business model. However, for the majority, it's been the only option, not a choice, and it's a temporary one in that case as well. So a clear picture on the current state of businesses and its optimism can be seen here from the most recent findings of the Canadian Federation of Independent Business, or the CFIB. Compared to 2 months ago, the number of businesses that are open has dropped by 11% to just over 50% of the businesses in Canada. That number should really be heart-wrenching, especially when we think about that previous slide and the proportion of small businesses that employ individuals across this country. Across Canada, areas are in lockdowns, with regions like Toronto and Peel being in lockdown for over 100 straight days. When factoring in the initial spring lockdown, some of these businesses were closed for almost half of a calendar year. So now obviously the lockdowns impact, the effect on all small businesses is different, especially when it comes to trying to determine which business anyone would consider essential. The number of businesses with normal sales only being 25% is challenging as well. There are only so many costs that a small business can reduce in order to keep themselves in the black. The numbers on the right-hand side indicate the reasons for those below normal sales, with the primary being fewer customers, followed by customers spending less. These cash flow constraints create 4 key struggles. Keeping employees on the payroll, covering rent obligations, prioritizing outstanding invoices, and all while trying to run their business to keep things kind of moving and to persevere through it. We've all seen dramatic shifts in the news and social media about sporting good companies now making medical protection supplies, rubber tire manufacturers now diverting to medical equipment. These innovations and resiliency is amazing. I love to read about them and hear about them, and we all kind of need a positive story, as it gives us kind of hope and optimism what's ahead of us here in 2021. So as we talk about cash flow constraints, it's important for us to discuss how the government has stepped in to provide relief. So when you watch the news, it's easy to see the updates of the billions and billions of dollars that the Canadian government has allocated to keep the economy up and running, and really think to yourself that it looks like it's a bailout across the board and it's way too much money. From a small business perspective, it's 100% not the case. If anything, the opinion of small businesses is that the government isn't providing enough relief, as the majority of credit facilities that are being provided have a hook or an obligation to pay back, or in the case of some BDCs or structured loans, require a personal obligation to facilitate. So these credit facilities are pointed and structured for a reason from our government, as it forces small business ownership to really truly consider the commitment that their business is going to have moving forward, and also the long-term viability of their business. It creates a decision point and a self-appointed triage that ensures funds are being issued to the fighters and not the flighters. Flighters, I know my grade 12 teacher would definitely be mad at me for using that word. The case of the credit programs and government subsidy is really a case of the sweet and sour. The sweet being that for the most widely issued program, the Canadian Emergency Bank Account, or CEBA, which has really been used by over 70% of the businesses in Canada. The federal government hit a decision point late last year where they're able to extend that funding out past the original $40,000 limit to that of $60,000. Their government took a progressive elaboration approach and was really able to respond in an agile fashion. It was impressive on how well this program worked and how over 200 financial institutions were able to issue these. The sour side on the government programs was definitely that of the Canadian Emergency Rent Assistance Program, or the CECRA. So this program was originally designed to offer relief to small businesses at their largest expense item, the rent. The problem with this program was that it was only able to be applied for by the small business's landlord and not the small business itself. What ended up happening was that very few landlords applied for this program on behalf of small businesses. The reasons vary from landlords, from property management companies simply having too many tenants to support, landlords having potential reasons to want to evict tenants, and to just not enough transparency from a small business to their landlord on their financial position. It took more than 6 months for an alternative program to be put in place, which ended up being the Canada Emergency Rent Subsidy, or the CERS. That CERS finally put the power of the subsidy request back to the hands of the business owner. It quickly took off once it was set up. The only remaining downside to this program is that subsidy can only be applied for once that given month has passed, but still it's much improved from its initial iteration. The most notable programs are listed here on the screen, and honestly, we could spend a few hours talking through them all. The only other one I'll cover here in detail is the 2020 Safe Restart Agreement. This is a $19 billion federal investment, which is aimed at doing exactly what it says, help us safely restart. The funds have been allocated to testing, to healthcare, vulnerable populations, personal protection equipment, as well as for the support to municipalities. We have a large number of cities and municipalities on the line here today, and it's important to remember that they're at the front lines to the safe restart of the economy. They manage the precautions surrounding public spaces and critical services like public transportation. So from a core credit perspective, the best way to explain what has been going on is that there's an extreme backlog of negative occurrence information happening in the market, and that's happening for a number of reasons. And it's piling up in a huge pending negative credit wave. So first of all, it was the deferrals. So just like the 20% of consumers that raced to defer their mortgages and car loans at the start of the pandemic, a similar situation unfolded on the small business credit front, albeit to a lesser degree. With small businesses, only 5% of all small businesses applied and received some form of financial or trade credit deferral. The larger the small business, the more likely they were to try to apply and receive a deferral from one of their suppliers, knowing essentially the time value of money. On average, these deferrals were 3 months in duration, and for extenuating circumstances, the odd ones were out to 6 months. So when you defer payments, especially for companies that are going through a cash flow crunch during a pandemic, you're prolonging the inevitable. Eventually, these businesses are going through the 30 plus, the 60 plus, the 90 plus day delinquency cycle and are pushed through to collections. But guess what was happening in collection space? Yet another form of delay. On the collection front, the collection agencies made a decision for the integrity of the industry not to put further strain on businesses. They held for a period of almost 9 months on not conducting outbound calls. And many altered their business models while this happened, lent their call centers out to other industries, but only processed inbound calls for small business making payments or inquiries. This was happening until about November or December of last year, when telecommunication companies started to open up their outbound streams slowly, which has now started to open up for the rest of the collection companies. When collection companies can't collect, items then go to the courts. But then guess what was happening in the legal space? Courts have been closed, trials delayed, or in some cases, we all know are held virtually. Everybody remembers that lawyer that dialed into the court case as a cat. And again, things aren't running as efficiently as courts were prior to the pandemic. It's just a continuation of this backlog process. And so this all goes to say that the primary indicator that we all use to gauge the health of the economy in bankruptcies for small businesses isn't as clear as we want it to be right now. There's a backlog, and this is even further compounded by the amount of interest-free government-backed loans have created a false cash flow perspective. As that dries up and these negative currents backlogs clear up, a surge of closures is coming. Unfortunately, at some major cities and municipalities that we're working with, we're currently seeing more than a doubling of early period negative occurrence volume happening over kind of a 3-month period. All right, so now for the charts. So let me frame this information for you. So within Equifax Small Business Database, we have 2 forms of credit trade line data that comes into us. Financial data, which comes from Canada's banks, credit unions, and alternative lenders, which are items like credit cards, lines of credit, mortgages, and auto loans. And the other are industrial trades. Industrial trades are the account receivable information from Canada's largest suppliers. So think of electrical distribution, plumbing manufacturers, equipment rental companies, essentially organizations that invoice tens, if not hundreds of thousands of small businesses per month. Both trade type inform the credit bureau of accounts that are in good standing, past due, and the amount of credit that's been extended. So when we look at this top left chart, there's a comparison of net new financial trades that were established in 2019 versus that of 2020. As you can see from the image, the pandemic has really slowed down the amount of loan originations within Canada's lenders. Right now, we're holding at kind of a reduced volume at around 45%. And this is a stark difference to the onset of the pandemic, which ranged from about 15 to 30% reduction between March and June. So unfortunately, this 45% reduction is the new normal right now. And so with the number holding steadily over the past 6 months, these volumes reduced for 2 primary reasons. The first being that there was a rapid influx of interest-free government-backed loans that hit the market mid-year last year through CETA, which was, as I mentioned earlier, the extension from that $40,000 to $60,000, which also happens to be the average ticket size of working capital or lines of credits for Canada's major lenders. The second reason is just the general state of the economy. The majority of Canada's small businesses are not in a position to grow their business and have used any capital that they've had or received from the government to shore up their business and pay down any pre-existing debt. When looking at the industrial trades, there's been a lot of resilience that's happened. While new trade in industrial trades has dropped in volume, they've only dropped 10% versus the 40% we're seeing in financial trades. This is consistent with what we saw in the onset of the pandemic, which only saw about a 10 to 20% drop. There's an asterisk here, however. As the volume is only reduced by 10%, the overall trade balance has reduced by almost 30%. So during that same time period. And what that tells us is two things: that collectively, credit managers across the country have buckled down their scorecards and reduced the credit limits being issued to small businesses. And secondly, that the amount of credit being requested by small businesses has reduced on average as well. Essentially, small businesses will take what they can get, but also only take what they need. So when we shift over to inquiries on the right-hand side, a very interesting trends emerged at the end of 2020. So this also gives us an indication of a potential surge of negative occurrence activity here in 2021. When we look at the inquiries, we blend both financial and industry trades together to give us a pulse of the overall market. What we saw in November and December as the second wave of COVID hit and lockdowns became more widespread was that credit inquiries dropped by 30%. The drop in inquiries is primarily allocated to small businesses, which aligns with the majority of lockdowns and also locking out to small businesses, big stores still remaining open. When we profile this across industries, this also tells us an interesting story. Mining sticks out like a sore thumb, but this is really primarily due to the struggles happening right now in Alberta in the oil and gas sector and the cost of oil per barrel. As we cascade down that list, retail, services, transportation, these are all industries that have taken the brunt of the lockdown restrictions. So in a few moments, we'll do a deep dive into the retail and food services with Jean Gauthier. But now that we have a good view on the originations, let's take a portfolio view of delinquencies and what is happening in the existing booked customers. So though delinquencies have stabilized over the past few months, there's still been a number of provinces that are reeling from the impact. Looking at this first chart, the overall delinquency rates, there was a spike in April and May of last year as the pandemic hit, and the market took a month to be able to react with deferrals. And the federal government also took a month to react with the tailored funding and subsidies. And once those took hold, the delinquency rates stabilized back to the pre-pandemic levels, which were in and around the 9% rate. Again, this is just an average. Industries like the equipment leasing space have this rate in around 1 or 2%. So again, this is an average for across all industries. Moving on to the next charts, we've separated financial trade and industry trade here. And the middle chart really compares the delinquency rates during the early stages of the pandemic, so March to June, to that of July and December. What we see here is that Alberta, New Brunswick, and Quebec have seen spikes when comparing their early pandemic rates to that of the later pandemic delinquency rates. The key thing to watch in these provinces for financial institutions and lenders is that if this trend continues over the next few months, and really how to mitigate this as much as possible through scorecards and the origination part of your business. The chart on the far right shows the early pandemic delinquency rates for industrial trades versus that of the later delinquency rates during the pandemic. When looking at the y-axis, it really shows you that there hasn't been much deviation during the pandemic. Some minor ebbs and flows with Newfoundland, Saskatchewan, and Yukon, but that's really it. This meshes quite well with the numbers shown on the previous slide, which showed a similar trend on the industrial trade, new trade volumes. So let's dig a little deeper here. When we use Equifax Business Navigator to view commercial delinquency score at a number of accounts level, with this case, Quebec, what we see is that from this perspective, there's really been little shifts between risk bands. Minor changes month to month over the past year, but nothing really worth noting. This in itself should provide us all with a general sense of comfort, but again, it doesn't really tell the full story. As something is really happening within these accounts that needs to be accounted for, and again, lends to the notion of pending surge with negative occurrences. So let's change the measure and take a look at it. When we look at the same geography by the amount of outstanding balance, here's where the devil is in the details. What this shows us is that high-risk accounts are starting to take more and more debt. What we're seeing is billions of dollars in outstanding debt fluctuations each month in these high-risk accounts. And this is just in Quebec alone. The rises and falls here are tied directly to the federal relief and subsidy programs. So when we look at the data, we really see a drop of about $1 billion in outstanding balance in high-risk accounts in May and June as the loans really hit the market. Then after those loans settle, we then see a spike again in the summer months. As we get into October, November, we see a drop in almost $3 billion in outstanding balances. So this coincides with the increase in CEBA loan availability to $60,000, as well as the announcement of the reconfigured rent assistance program. So with this in mind, let's take a quick look at credit utilization before looking at the food industry. So what we're looking at here is the financial trades, and specifically their average monthly utilization rates here in Ontario. As has been commonplace with the majority of you on the line that we've spoken to over the past few months, and for the majority of your customers, they've used government funding to reduce outstanding debts and reduce usage of extended credit. Since the government funding's hit the market, we've seen an average 7% decrease in the utilization levels of extended credit. Over the last 6 months of 2020, the average of credit utilization rate in Ontario averaged around 72%. So obviously this varies across the country. So let's also then take a quick look at Quebec. So prior to the pandemic, utilization rates in Quebec were a lot higher on average in comparison to Ontario. Quebec stood at about 87% prior to the pandemic, and the government funding and subsidies only reduced it by 3% compared to the 7% in Ontario. So that now sits in Quebec around 84%. So if you're curious about detailed trends in any specific province or profile, please feel free to reach out to your contact at Equifax to bring that up with you, or you can reach out to me directly. I'll show you my contact information at the end of the presentation as well. So with this, I'll pause here now and refer out to Sinead Gleason. Sinead, are there any pertinent questions from the audience that we'd like to table?
Yep. Can you hear me, Jeff?
Yeah, I can hear you.
Great. Yes, we have two questions. One, are the volume reductions in number of apps or the total size of requested dollars? And are we also seeing the average requested size of credit reducing, or is it just the total? That's the first question.
Okay, so the first answer to that question is based on the number of apps. So that is based on the pure number of net new trades that are established. The dollar value has decreased in the financial sector, but not as much as the industrial. So I had mentioned that in the industrial trades, it's dropped by about 30%. Financial trades in around 10 to 15%.
Great, thank you. And also, how will the government subsidies or guaranteed credit impact the Equifax Bureau of the Small Businesses or Business Owners Personal Bureau? Will they be treated the same way as other regular credit facilities?
So that's a really good question, and we've actually been asked that from a number of financial institutions. When the government subsidies do actually show up in our report, so when a CEBA loan is reported in from a financial institution, a lot of people would deem that as maybe potentially being negative, that hey, this organization needed a bailout or to be sustained, and really when that data is reported into our credit report, we're not seeing it as a negative occurrence. It's basically just another trade line. It's not going to go through and bring down the credit score or the credit limit of that account. Basically, we've included it in there for general awareness. So we don't want to put a small business in a space of maybe not being able to dig up themselves out of a hole. And really, when we look at it, that number of 70% of businesses in Canada really taking these loans on, again, it's majority of businesses that are taking these on. Some are seeing it as an opportunity that they get an interest-free government-backed loan, and others are using it because they absolutely have to. So it does not penalize any business and their score that's related to it.
Great. And then I think last, there are two questions here. One is, I can see in your table that you can sort through this by industry group. Any surprises with industries not affected or industries thriving? And then another question, can you discuss HASCAP, H-A-S-C-A-P?
All right. So the second one, I'll defer out to FAQ after. The first, yeah, I mean, it is surprising. So like I mentioned, Jean's going to go through what's happening to the food service industry. And, we've been doing a lot of work recently with cities and municipalities. And we go in, just like anybody, with a preconceived notion about how this pandemic has hit a certain area. And everybody's really assuming as you go into it that it's going to be the food service industry. That's really number one. And when we've been talking to certain regions of Canada, it's actually been other industries, and it's actually been showing a more severe impact than we initially assumed. So some it's been transportation and logistics. So knowing that some cities are main conduits for the import of export of goods, or that basically hold goods before they're actually sent down to the U.S. for distribution. A lot of these organizations, because there was a lack of incoming goods coming into the country, that's been, I think, the biggest shock is transportation and logistics. And there's been a big hold on that, and really it's concerning because not only does it affect that city and municipality, but it affects the province and the rest of Canada who those goods are sent out to as well. So I would say that's been the biggest shock. Also going through and just understanding the different profiles of some businesses in Canada, things like golf courses. You go through with the assumption that, a golf course has been there for 20, 30 years, and that they were one of the first kind of groupings of companies that were able to come out of the lockdown when we had a lockdown last spring. And that, they're getting new patrons through and they're able to go through and play golf. But really what you learn by go through and profiling things like golf courses, and again, this is very secular to certain ones, but ones that also have events like weddings and banquets and things like that. That's a big part of their income. And it's become really apparent in how critical those events are for the sustainability of these golf courses and their expenses. So it's been a few ones like that. And I won't give away kind of any kind of secrets around some of the cities that we've been talking to in detail, but it's really allowed us to get a deeper view and understanding about how critical parts of certain businesses are. So it's been really sobering having these conversations. And the one thing I would say is you can't really go in with preconceived notions. You really have to go through and examine the data to see what it shows you.
All right, and perhaps one final question before we move on to the next segment. How many businesses will go out of business once government subsidies end? Not sure if you're able to share any insights or thoughts on that.
Okay, so I'm going to hold that one for Jean to talk about that specific that industry first, and then we can tailor that towards the end. Because again, food service industry is arguably the largest impact and the biggest indicator. So allow him to really speak to that, and then I'll address the overall economy at the end of the session.
Great.
Perfect. All right. So with that, I'll pass it over to Jean Gauthier, who's been waiting here patiently to walk through food service insights. So, Jean, thanks again for joining us here today, and the stage is yours.
All right. Thank you very much, Jeff. So my name is Jean Gauthier. I'm the president and founder of the Profile Credit. So we are known under the Food Industry Credit Bureau across Canada as well. So we're servicing approximately 2,500 people in the food industry across Canada and in the States as well. So you see basically some of our members, the Saputos, the Gordon, which is GFS, it goes in Cargill, Maple Leaf. So we update like 250,000 files on a monthly basis, and we have like over $5 billion that we're gathering on a monthly basis worth of information. So my background is I was a stockbroker actually in Toronto before I started this business 30 years ago. And I'm an accountant. Never worked in accounting though, but I'm more like a finance guy that is very specialized in the food industry. So let's talk about a slide here on the retail side. It's important that you make a difference between the retail industry and in the food industry and the food service. So retail is basically the Sobeys, Loblaws, and Costco and Walmart. So this is the slide that we're showing you over here. So it's Christmas Day. It has been like a Christmas Day every single day in the last year since the beginning of COVID. So sales are up by $11 billion. So they saw growth, 4 times more growth than in the last year. So, and people had big parties during Easter, Thanksgiving, and Christmas. So right after Christmas, though, it looks like people bought too many turkeys, and they didn't eat, they didn't buy some more food actually after Christmas. So on the food service side, it's important to know as well that we have hotel, restaurant, institution. So the hotels and the restaurants are the two that are being affected the most right now. The institutions are doing well. The prisons and the obviously they don't see any. They're not being affected by the COVID. This slide is from PricewaterhouseCoopers. It's basically the past behaviors and post-COVID. So we see here, I put some arrows over here. So these are the sector actually that will be the most affected by COVID. So we see that a lot of these sectors will be have food. Actually, they're selling food. So like boat cruise, for example, concerts, going to bars and stuff like that. So these one, people feel that they're going to feel more discomfort actually going back to these places. Here, restaurants, it's basically half and half, and going to grocery, people are comfortable. The habits versus the behaviors. Jeff was talking briefly about that. In other words, basically a habit is, a change that we have no choice to do. Actually, basically, curfew. We have curfew in Quebec. Lockdown. We can't go to any stores, or we're limited to our how many people we were allowed to go in stores, and so on and so on. The change of behaviors are the one that we're kind of don't know exactly what will be the effect after COVID. It's basically the long-term effect actually of a change of habits. So basically, if people are not going back to restaurants, they still continue to work from home, that will have a big effect on the food service industries. So what I do when we have situations that are like a little bit awkward, we go back to the basics, so the 5 C's of credit. So basically, I'm going to run you through a little bit what the credit managers are doing, at the big companies and all the food service suppliers with their restaurants. So the capacity or cash flow, they're wondering, will the business still have the same cash flow to operate after the COVID when everything will reopen? So I'm talking mostly about Quebec and Ontario. We're going to see the prairies and the BC after that. I have some slides for you guys. So basically, when you consider that you're going to have to put together like a new inventory to rehire staff, put some marketing on place, it could take up to 8 to 9 months actually to reset everything to the pre-COVID norm. So this is something actually that we're looking at right now. Will they have the same credit terms from other suppliers? So we're seeing some shorter terms actually being offered to the restaurants right now. So and the hotel industry. So we saw a lot of 30 days and 45 days before, and now we're seeing more and more like shorter terms, like 7, 14 days, 21 days. So that will have an effect on the cash flow. Will we have food inflation? So we're heading towards some inflation, and obviously the food in the food industry, they will take advantage of that, and they might increase their prices. So we'll see. We're looking forward to see that. The last one over here is, will the franchisors, landlord, and banks help them after the measure from the government gone? So basically, we haven't heard too much from them, during the COVID. The banks were not too aggressive trying to collect their money. Landlords neither. So with the subsidies and all the loans that Jeff talked about, it's basically, I think these people were okay and gave a chance to their franchisees or customers to go through the first and second wave. The second one is the most difficult one to assess for a credit manager. It's the condition in which the restaurant is operating. So I'm talking about mostly restaurants here. So, but that could actually apply to other sub-industries, some of your industry that are not necessarily the food industry. So office towers, so where are they operating? So office tower, we saw some bankruptcies in office towers, like pharmacies that we never seen before. Are they in the suburbs? Suburbs are doing quite well right now. Shopping mall, obviously, if you're in a food court, you know, you're being affected a lot. Are you in a touristic area? There's no tourism right now, or in a remote village, you know, away from COVID. So it really depends where you're operating your business. Do they have any takeout deliveries? Uber Eats, DoorDash, Get Dishes? Do they have any menu to eat from home? So any takeout? What type of restaurants are they operating? So is it a white table cloth type of restaurants? Is it a buffet style of restaurant, QSR, quick service restaurant, or a sushi bar? So, you know, a lot of them, quick service restaurants and sushi bars have been doing extremely well. Some others are less well. Will we have some restriction like this, like social distancing? So obviously, you know, in restaurants, so if you're a restaurant with 50 seats and you have to cut back 25 seats, you know, in order for the social distancing, so it will make a big difference. The meeting rooms in hotels, conferences, weddings, cultural events, sports events, that will have a big effect as well. Working from home will have an impact of $20 billion in the industry if people are working just 2 to 3 days from home in 2021. So that's a big shift. So it's a $20 billion that will go to the retail industry instead of keeping it within the food service industry. So people have invested a lot in their backyards and cocooning. Will the manpower be back after almost a year not working into the food service industry? So this is something that we're looking forward to see actually. Insurance costs, the premiums have been going up a lot actually over the last couple of years. And you know, instead of paying $6,000, I heard some situation where the premiums went up by to $10,000. So that could discourage as well some of the people as well in the industry. Character. So basically, the owner and management have been cooperating with transparency during the pandemic. How's the moral? Have they done well during the COVID, considering their conditions? So we want to know a little bit more about how the small business owners in the restaurant industry are doing. Capital, do they have any assets and possibility to refinance? And collateral, do they have any personal and corporate guarantees? Accelerating trends and impact due to the COVID. So basically, working from home, ghost restaurants. I don't know if you guys heard that Kraft opened 3 restaurants in Canada, being ghost restaurant. They call them Kitchen 57. So you can order directly from Kraft. They're basically hidden restaurants, so without any. They're not on the street itself. Cocooning and meal kit, good food and cook it, you know, are some examples of companies that have been doing extremely well during these COVID time. The restaurant industry is showing lots of resilience during the lockdown, so no doubt that the measures taken by the government, the billions of dollars that have helped the industry. We haven't seen lots of bankruptcies. I'm going to show you some numbers right after. The sales during the first wave were quite good, actually. People really encouraged the restaurant industry. During the second wave, we saw a big drop, actually, in terms of volume, in terms of sales into the restaurant industry. However, we see lots of zombies. So these are restaurants that are closed down. They're not bankrupt, and we don't know if they will reopen. So this is the Canadian Restaurant Association, Canada Restaurant Association. They said that they're just like 80,000 restaurants across Canada, and they're talking about approximately 25% of the restaurants that would not survive to the COVID. So what does it mean? It means that they might not necessarily go bankrupt, but they might close down their doors. I find this number a little bit high. I would probably cut it in half, but still 10,000 restaurants that would close down across Canada would be still a big number. Right now, the number of bankruptcies we're seeing in hotel and restaurants, the restaurants are, so we're seeing like in December, we're gathering all the information from the superintendent of bankruptcies, and we saw only 22 restaurants that went bankrupt across Canada. So this is a number that nobody would have thought back in May, June last year. We were expecting probably 200, 300 restaurants per month that would go bankrupt. But with what we just said, with all the subsidies and the granted the loans from the government, it really helped the industry to just make a pause during the COVID time. These are some numbers actually from our database. It's basically the Quebec Food Service. I have Ontario, and the two other slides will be Prairies and BC. So the orange line is the percentage of current accounts. So basically, it's if let's say a supplier is being owed like or a customer owes $100,000. Last year they were paying at 70% current, and they dropped, a little bit closer to the 65%. So that was last year. And we see that, at the beginning of COVID, obviously, it dropped to 40%. So that it was like almost a 25 to 30% drop here in the Quebec area. Ontario wasn't that bad. So we see that the white line, so this year, we haven't gone over the last year curve. But we see that BC actually has done much better during COVID time, actually. So compared to last year in orange. These are the alerts that we're gathering. So again, the Quebec, Ontario, and Prairies in BC. So we see the numbers are much higher here in Quebec. Lot more NSF checks. We're gathering all the NSF checks reported by our members. Cases of collection and legal records. So again, the orange one was last year and this year. So the reason why we see a little bit less alerts, it's basically the first reason is that the people have been more finance oriented, or they took care a little bit more on their finance side of their business. And the second reason is basically because there were a lot less transactions, so and a lot there were more restaurant closed. So Ontario, as you can see, the volume is the average is more like in the 80-100 here. Here we're seeing more in this average, so maybe 20% more in Quebec. Prairies, we see a big drop, compared to last year, and BC, BC is like they're kind of behaving much better than the rest of Canada. Percentage of risk for the just to give you an example of the food service industry in Ontario. So basically, we see a lot more risk compared to last year. So that this is February 2021 on the right side and February 2020 on the left side. So 1.5 million. So we have a good sample over here. We have $60 million worth of sales on the left side in 2020. and it dropped by 42 million. So we were talking about, or we'll talk about, that the sales were down by 30%, 32% in the last year. So that pie charts, these two pie charts reflect the 32% drop in sales actually in the last year. So we see a lot more risk over here in terms of percentage. These two red, we're talking about 32% in 2020 of high risk. And on the right side, we're talking about 40% more risk. So we see more risk actually in the industry. 45, okay, I have two more slides. So just to show you quickly here from StatCan, so we saw that sales were dropped by 32% last year. So it's going to take a while before going back to the same level where we were prior to COVID. So right now, the cycle of market emoji, I like this one, the food retailers, the real estate market, the stock market, everybody's there right now. It's basically the euphoria. So we're not going down. We don't see any downturn over here. But the restaurant industry, I would say that we're probably between the depression and hope right now with the spring outside, the nice weather that we have, and the vaccine and everything. So there are lots of hope over here from the restaurant owners that are the most affected. Again, there are some restaurant owners that are doing well, and there are some that are not doing too well during this COVID day. So we have a solution. Actually, we are a reseller, an Equifax commercial credit reports reseller. So the solution that we found actually is a combination of this score, the CDS2, our credit scores that is strictly food. So our members are, like I said at the beginning, we're gathering like close to $5 billion worth of data on a monthly basis. Prior to COVID, we were at $8 billion. So basically, the combination of this scoring, and we have a new scoring from a partner that we work together. It's a company called Griso. It's a startup, and basically they do a scoring on the social media in the restaurant industry. So they look at the vitality. Just can't see the slide very well, sorry. Visibility. So website, do they have any a website, a Facebook, Instagram, Yelp, and TripAdvisor? And the second score over here, even if they have all these social media, do they take care, do they post anything on these website or social media like Facebook? Are there any comments from the consumers, their customers? So we see in this case that there's nothing really happening. And the last one over here that we see is the online reputation. So so the Google score, Facebook scores, and so basically if you see a drop by 0.5, let's say 4.5 score out of 5 and compared to a 4, it makes a difference between 5 to 10% on their sales actually. So the general score is at 43%, so which is low. Our score on our side, it works from 0 to 100. So 100 is the best score and 0 is the worst. So this is really for the same company what we're showing right now. So that's about it on my side. Thank you very much, Jeff, and the Equifax team for
Perfect, Jean. So thank you very much for sharing that intelligence. So all right, here we're just on the final stretch. So John and I have covered a lot of ground on the data, the insights happening in the market. So now we want to talk about how these can be put into action. So one of the most important insights I'd like to draw your attention to above and beyond the data is really the unsung heroes in Canada right now. So these are members of the emergency response teams. So emergency response teams have been formed at various levels of the government, from economic development to policy advisors to government relations. they've become a task force to really put data into action. They're finding small businesses that are in jeopardy, working with top employers in their jurisdictions, and really ensuring that they have access to and are aware of, and are really leveraging any subsidy or relief that could be made available. So this also exists in some of Canada's banks and suppliers, but it's truly remarkable to see what has been happening at a grassroots level to ensure the integrity of our economy. So as John and I have covered, a number of traditional ways businesses are profiled to monitor health simply can't be leveraged the same way they were before. So within cities and municipalities, business directories have been helpful, but the total population, especially around the gig economy, isn't captured. For bankruptcies, as mentioned during the negative credit life cycle slide, they're misleading. Where response teams have really been leaning into, like we all should, is understanding the active versus inactive businesses. So does the lockdown actually mean that a business is closed? Do they still have continual cycles of trade credit being established? And as Jean mentioned, do they have online or social media presence? Or have they given up and would be part of that coming wave of business closures? So we have the luxury of having daily conversations with some of Canada's largest cities. And the trend that we've really seen, as I mentioned earlier up the top, is really that we've seen the negative occurrences have consistently doubled over the past 3 months. So that wave is starting to open up as these subsidies have really been used by small businesses. So with this all being said, it's truly interesting to see how some of the levels of the government have altered or leveraged their roles during the pandemic. Economic development offices have pivoted from trying to bring in net new businesses to really operating as a sustainability team, understanding which businesses may need to have specialized incentives and to proactively work with key suppliers and employers. Government relations have turned it up to high gear and are actively lobbying with other levels of government to support businesses. Finance departments are identifying businesses in trouble and that are unlikely to pay their property taxes and proactively providing deferrals and payment exemptions for these. Community services are actively engaging with and surveying small businesses to ensure their voices are being heard and that the collective troubles that are really making their way to city and municipal councillors. So the list really goes on, but the bottom line is they're acting differently and they're empowered. So along with this, there's an active triage really happening across Canada with suppliers and the government. Help is available to small businesses, but it's required to be focused to help those businesses that really are able to be viable. So to wrap it up, how can you put everything that we've talked about really into action? Navigate to your insights. So commit to truly understanding your organization's challenges and leverage the data to help solve them. If you're a supplier, how do you manage your scorecards differently versus before the pandemic? If you're a financial institution, how do your marketing efforts help compensate for that dramatic loss in net new trades? Now is not the time to kind of sit on your hands and wait for the pandemic to end and for the government subsidies to stop flowing. Now is the time to nurture existing customers and to pick up high potential candidates that might be neglected from your competitors. If you're in a government, in a city and municipal level, are you part of the leaders that are really supporting an increased capacity recommendations for small businesses during lockdowns? Or are you just kind of accepting what is cascading down? There's been a lot of challenges happening at the city municipal level where small businesses are really frustrated in that big box stores are able to remain open where small businesses aren't. So there's a lot of advocating happening, again, at that grassroots level saying, hey, if we're going into full lockdown, if we had a capacity at 25 before the pandemic, at least let us be 5. Let us reduce some of the waiting times of the big box stores. Let us help us survive. So the data is really helping kind of pinpoint where and how that should happen. And you're seeing a lot of city and municipal councillors across Canada really advocate to their government and the ones above. So really find that hidden gem in your data and maximize its value. And lastly, if you haven't already created a response team, do it now. It's not too late. If the pandemic has shown us anything, the scenario continues to evolve. So get ahead of the next wave and support your business and the small businesses around you. So with that, I'd like to thank all of you who have attended today and our guest, Jean Gauthier, and the team of people who helped coordinate the content and really set up the webinar. So I wish everybody the best and look forward to seeing you and speaking with you in the near future. Thank you very much.